Welcome to the deep dive. Okay, so today we're tackling, well, probably the biggest financial headline out there right now. Gold. It's absolutely surging.
Yeah, you really can't miss it. We're talking record highs. Since the start of the year, so mid-October 2025 now, gold's up something like 50, maybe 60% in U.S. dollars.
Blasting past $4,300 an ounce. I mean, on the surface, it looks like a classic flight to safety, right? Like the market's saying, okay, the dollar's looking shaky.
Exactly. That's the textbook interpretation. But
I get that.
there's a bit of a puzzle here.
That's what we need to unpack for you, because while gold's hitting these incredible highs, Bitcoin's response has been, well, pretty muted.
Muted is a good word. Low double-digit returns this year. It even dipped down near $104,000 recently.
Yeah, it's been moving so sideways that some analysts are kind of joking it's become the stable coin of the year.
Which is funny, but it really highlights the contrast.
Yeah.
And that contrast forces the big question, our mission for today. Is this gold rally the main event?
Or is it maybe, just maybe, a kind of red herring, a distraction from something quieter, more fundamental happening underneath?
Right. Are people focusing on the shiny object while the truly scarce asset is being accumulated elsewhere? To figure that out, we argue you got to stop using a broken ruler to measure things.
Okay, let's start right there. The broken ruler. You mean the U.S. dollar.
Precisely. The sources we looked at really hammer this point home. Gold looks strong, yeah, but maybe only because we're pricing it in dollars.
In the dollar itself. Well, it's designed to inflate, isn't it? It loses purchasing power over time. That's just baked in.
Exactly. By design, it only goes down long term. So if you measure anything against a ruler that's constantly shrinking,
everything eventually looks like it's going up. Makes sense. You feel good saying your investment doubled, but what if the yardstick you used shrank by half or more?
you haven't actually gained much, or maybe you've even lost ground in real terms. So this is where the idea of a different benchmark comes in, the Bitcoin hurdle rate.
Okay, explain that. Using Bitcoin as the yardstick.
Yeah. Use Bitcoin, the finite, non-debasable asset we know can't be inflated away, as the measure. Let's look at performance since, say, January 2020, using Bitcoin as the unit of account.
All right, let's run the numbers. The S&P 500 doing great in dollar terms since 2020, up 100%. Sounds fantastic.
Fantastic on paper, maybe. But price, that same S&P 500 performance in Bitcoin,
Uh-oh.
it's down, way down 88% when priced in Bitcoin.
Wow, okay, let that sink in. An 88% loss against absolute scarcity. So what about gold, the asset of the hour?
Gold's done better than the S&P in dollar terms, up about 150% over that same period.
Okay, 150% sounds really strong.
It does, until you measure it against the hurdle rate. Denominated in Bitcoin, gold is down 84%.
84% down. So even the big winner, gold, has lost massive ground relative to Bitcoin since 2020.
It really reframes the narrative, doesn't it? You might feel richer because your dollar amount went up, but compared to the hardest asset, your purchasing power has actually cratered.
The takeaway seems pretty stark then. If you can't beat the hurdle rate.
The argument is you should probably just buy the hurdle rate. Buy Bitcoin.
Okay, but let's pressure test this. If gold's surge was genuinely about a flight to hard assets, like a broad inflation hedge.
Then you'd expect other hard assets to be rallying too, right? Real estate, maybe commodities.
Exactly, but are they? The evidence seems, well, mixed at best, especially in housing.
Yeah, let's look at housing. It's the classic hard asset people think of. But the data, like from Realtor.com's August 2025 report, it tells a very, very different story than gold's euphoria.
What's it showing? Not a buying frenzy?
Not at all. It looks like cooling. Active listings, up over 20% year over year. Pending sales are actually down slightly.
Okay, more houses for sale, fewer deals closing. What about prices?
Homes are sitting on the market longer, about 60 days, a full week longer than last year. And the big one, the national median list price is basically flat compared to last year. It even dropped month over month.
Flat prices, more inventory, slower sales. That doesn't sound like a rush into hard assets.
Not even close. Newsweek apparently called it a deflationary vortex in housing. That suggests this gold thing isn't some universal dash for tangible stuff because of inflation fears.
So if it's not a broad, hard asset rally, what is driving gold specifically?
The analysis points towards something more like, well, emotional FOMO, fear of missing out, or maybe just crowd behavior chasing the winner.
Triggered by specific things.
Yeah, very specific, short-term signals. Things like central banks hinting at rate cuts, making money cheaper, governments running huge deficits, and importantly, compressing real yields.
Okay, let's quickly unpack compressing real yields for everyone. Why does that push people into gold?
Sure. So real yield is basically the return you get on a super safe investment like a government bond after you subtract inflation.
So what you actually earn in real purchasing power.
Exactly. When that real yield gets smaller or compresses, holding cash or bonds becomes less attractive. The return just isn't keeping up.
So the opportunity cost of holding something that doesn't pay a yield, like gold, goes down.
Precisely. Suddenly, holding gold doesn't feel like you're missing out on juicy bond returns because those returns aren't so juicy anymore after inflation. So traditional money flows into gold.
Gotcha. So the gold surge is more about those specific financial mechanics, rate cut signals, low real yields, rather than some deep fundamental shift across all hard assets.
That seems to be the argument, yeah. It's a reaction to perceived monetary policy shifts that specifically favor gold in the short term.
Okay, so gold is the noisy trade, the emotional FOMO play based on those triggers. But if the really smart money, the long-term players, aren't necessarily piling into gold, what are they doing?
Now, here's where our sources suggest things get really interesting, because the argument is that the truly significant accumulation, the fundamental play, is happening much more quietly, in the shadows almost.
Focused on.
Focus on the truly scarce asset, Bitcoin. And we're not just talking about individuals, we're talking about governments,
Yeah.
sovereign stacking.
Governments accumulating Bitcoin. How? Are they buying it on the open market?
Not necessarily. They've found let's call it a budget-neutral way to do it, confiscation.
You mean seizing it from criminals?
Exactly. Law enforcement actions,
But
regulatory crackdowns, they're seizing huge amounts of crypto. There's that example, what was it, $15 billion worth seized from some Cambodian scam operation.
okay, yeah, I remember hearing about massive seizures, but what do they do with it? Don't they usually auction it off?
That used to be the assumption. But the crucial point here is that governments like the US and the UK are reportedly not immediately liquidating all of it. They're holding significant amounts on their balance sheets.
Whoa. So they're effectively building up national Bitcoin reserves without spending a dime of taxpayer money.
That's the mechanism, a sovereign Bitcoin accumulation mechanism. It aligns their incentives perfectly with quiet, long-term holding. Why sell it cheap if you think it's valuable long-term, especially when you got it for free?
It's quite a thought. The source even draws a historical parallel, right, to gold.
Yeah, to Executive Order 62102 back in 1933, when the U.S. government basically forced citizens to hand over their gold. It's about consolidating control over the key monetary asset. Seizing and holding Bitcoin achieves a similar strategic goal in the digital age, and it happens off-market, so it doesn't necessarily pump the price immediately.
Which could explain why Bitcoin's price can seem sluggish even while these huge entities are potentially absorbing supply.
Precisely. And it's not just governments. The institutional shift is undeniable now, isn't it?
Oh, absolutely. You see the big names, BlackRock, Fidelity, Schwab, Morgan Stanley, all rolling out more crypto access, more products.
The demand is clearly there. Look at the Bitcoin ETFs. They've been consistently absorbing huge chunks of the newly mined Bitcoin supply. Some days, reportedly matching or even exceeding the new issuance.
So institutions are basically buying up a significant portion of all new Bitcoins hitting the market.
That's what the data suggests. And the narrative is shifting. It's moving away from Bitcoin is just speculation towards Bitcoin is the base layer, the foundational asset.
You even see talk about how investment products like derivatives or futures might eventually see pressure to convert into actual physical Bitcoin as institutional demand for true ownership grows.
Right. The demand for the real thing, not just paper claims.
Okay, so we have a quiet government accumulation and accelerating institutional adoption. This leads us to a really critical theory explaining the timing, why gold now, Bitcoin later, the asset rotation cascade.
Yes, this is key to understanding the sequence. The idea is linked to quantitative easing, or QE, when central banks pump liquidity into the system.
That money printing.
Right. But that new money doesn't just spread evenly everywhere at once. It flows in a somewhat predictable pattern, hitting different asset classes in sequence.
And gold is step one.
Gold is the first responder, according to this theory.
Why gold first? What's special about gold investors?
It's about the mindset. Think about the traditional gold buyer. They tend to be older, they understand scarcity in a physical sense, they prioritize wealth preservation.
So when they see QE, massive government spending, ballooning deficits,
Their first instinct is, protect my wealth. And historically, that meant buying gold. It's the knee-jerk reaction to secure purchasing power. That's phase one.
and that's the $4,300 gold price we're seeing right now. Phase one in full swing.
Exactly. Gold rallies first, securing wealth.
Okay, so what happens next? Where does that liquidity flow after gold?
Phase 2. Once wealth feels secured, risk appetite starts to return. That liquidity looks for higher returns, bigger percentage gains, so it moves into riskier assets.
Like tech stocks, the NASDAQ, broader equities.
Yep. NASDAQ Q growth stocks, the general stock market, that's phase 2, deploying the newly created liquidity into assets with higher potential upside, even if they carry more risk than gold.
All right, so phase 1, gold, phase 2, stocks. Where does Bitcoin fit in?
Bitcoin is phase 3. It's typically the last asset to run in this QE-driven cascade.
Last. Why last?
Well, it's still newer, perceived as riskier by the mainstream perhaps. But the key is, according to this model, it has the most intrinsic leverage of all assets.
Intrinsic leverage, because of its fixed supply.
Exactly. Its absolute scarcity means that when the big wave of liquidity finally rotates into it, the price impact can be disproportionately large. It has the greatest potential volatility, both up and down, but especially up in this scenario.
So the implication here is huge. If gold hitting all-time highs is just phase 1.
It means the main event, the big Bitcoin bull run fueled by this liquidity rotation, hasn't even really started yet. Gold's peak is actually the signal that we're just setting the stage for phase 3.
Wow. That completely flips the script on the gold rally being the final destination. It's just the first stop.
That's the theory. It positions gold as a leading indicator for the eventual, more explosive move in Bitcoin.
Okay, but this whole cascade idea relies on Bitcoin being fundamentally superior, engineered to outperform gold, stocks, everything else long-term. Let's dig into why that might be the case. Gold's been money for thousands of years.
And that's a common objection, right? Why trust this 15-year-old digital thing over millennia of history? The argument boils down to fixing gold's inherent flaws.
Flaws. What flaws does gold have as hard money?
Two main ones, according to the sources. Its supply isn't truly fixed, and it requires centralization to work at scale.
Okay, supply first. We think of gold as scarce, but it's not absolutely scarce?
Correct. New gold is always being discovered. You hear reports, like that recent one about potentially one of the largest deposits ever found. Plus, there's recycling. So the supply does expand, maybe slowly, but it expands.
Unlike Bitcoin.
Unlike Bitcoin, which has that hard cap of 21 million coins ever. Plus, predictable halving events that cut the new supply rate in half roughly every 4 years. It's absolute, provable scarcity. No new discovery can change that.
Okay, that's the supply argument. What about centralization? How does gold require centralization?
Think about using gold in a large global economy. You can't just carry bars around easily or verify purity instantly. You need trusted third parties.
Banks, vaults, governments.
Exactly. You need someone to store it, verify it, facilitate transactions. Gold itself, the bare physical metal, doesn't have its own payment network. Its final settlement relies on trusting these central institutions.
And history shows that trust can break down, especially in crises, like the 1933 gold confiscation you mentioned.
Precisely. Bitcoin was designed to solve this. It's both a scarce bearer asset and a decentralized network. It achieves transaction finality globally without needing permission from any bank or government.
So, provable scarcity plus a decentralized network for settlement. That's the core advantage.
That's the argument for its fundamental superiority as a monetary network.
Okay, but let's tackle the elephant in the room, volatility. People see Bitcoin's price swings and think, how can that be a safe store of value?
Yeah, and it's crucial to separate risk from volatility. They're not the same thing.
How do the sources define the difference here?
Risk in this context is the chance of a permanent loss of capital. Like, the Bitcoin network fails, the code breaks, it gets shut down somehow.
And the argument is that risk is low.
Relatively low, yes. Because the network is decentralized, globally distributed, and you can secure your Bitcoin yourself. Even just by memorizing your seed phrase, you don't need a third party. How do you permanently lose something stored in your head?
Okay, fair point. So that's risk. What about volatility then, the price swings?
Volatility is just the magnitude of price fluctuation. And here's the key insight, the aha moment maybe.
Yeah.
For Bitcoin, volatility isn't a bug, it's a feature.
A feature? How is wild price swings a good thing?
Because the asset supply is perfectly inelastic.
Meaning the supply cannot react to changes in demand.
Exactly. If demand for, say, corn goes up, farmers can plant more corn next season and the supply increases to meet the demand, which dampens the price spike.
But you can't plant more Bitcoin.
You absolutely cannot. The supply schedule is fixed. So when demand for Bitcoin surges, the supply literally cannot expand to absorb it. The only way the market can clear, the only way price discovery can happen, is for the price to move dramatically.
So more demand must equal a higher price, potentially much higher, because new supply can't come online to meet it.
That's the mechanism. The volatility is the direct, unavoidable result of growing global demand hitting a perfectly fixed supply. It's the sound of adoption happening in real time against absolute scarcity.
And if you see volatility that way, as just the price adjusting to inelastic supply, the only real risk is timing your entry or exit, not the asset fundamentally disappearing.
Pretty much, it reframes what we consider safe. And this inelasticity is why, despite the volatility, Bitcoin has averaged, what, something like 100% annual growth over the last decade?
Compared to gold's maybe 2% average over the long run.
Exactly. The structure is built for appreciation as adoption grows. The volatility is the price you pay, or rather the signal you see, for that potential upside.
Okay, so let's wrap this up. We've journeyed from the screaming gold headlines to the quiet accumulation underneath. What's the final takeaway for you, the listener?
It seems you're faced with a choice, really. A choice based on interpreting the data differently.
Option 1, chase the gold rally. Join the momentum, ride phase 1 of this potential liquidity cascade. It feels good the price is going up now, but it might be driven by short-term factors and FOMO, measured against that shrinking dollar ruler.
Option 2, look past the noise. Understand the argument for Bitcoin's absolute scarcity and network superiority. Recognize that quiet accumulation by major players, governments, institutions might be the real long-term signal. This is like positioning for phase 3.
It's the difference between chasing the first responder versus accumulating the asset that's potentially the final destination for monetary energy.
The gold rally might just be masking this deeper foundational shift towards the asset that's truly engineered to outperform in an era of endless money printing.
And that leaves us with a final, pretty provocative thought to consider.
Yeah, think about this. The sources predict that as global understanding grows, as more people realize Bitcoin literally cannot be printed or debased, well, there possibly won't be enough Bitcoin to go around.
Especially if government accumulation continues and institutional demand keeps soaking up new supply.
What happens when the retail crowd, the FOMO money that's currently piling into gold, eventually realizes the game? What happens when that wave of attention and capital shifts from phase 1, gold, to phase 3, the asset with absolute, mathematically enforced scarcity?
That potential collision of accelerating demand with perfectly inelastic supply, that's the explosion phase 3 hints at. Something to definitely keep watching.